Hello, and welcome to the No Bad Questions podcast, where I try to learn in a conversational manner by sitting down with people who have interesting careers, important lessons to tell, or inspiring stories. I hope that you learn something too. If you want to support the podcast, please follow or subscribe on your platform of choice. You can also like or comment to boost the algorithms or share out to your network to make sure it gets more views. But ultimately, and what I hope you choose to do, is listen to the very end. With that, we'll start today's podcast. Hello, everyone, and welcome to this week's episode of the No Bad Questions podcast. My guest this week is Kelly Iannone. Kelly, along with her husband, John, are the founders of Waypoint Commercial Investment Partners and have been real estate entrepreneurs since 2017. They have a portfolio of 409 units throughout Florida, Georgia, and Texas, valued at over $45 million. For their private holdings, they handle all aspects of the business while managing full-time property managers and general contractors. For syndications, and we'll get into what the heck that means, Kelly is involved in the underwriting of properties, raising capital, and handling investor relations throughout the hold period. Kelly is an advocate for the FIRE, Financial Independence Retire Early movement and community, and that's where I heard about her, and is passionate about helping others achieve financial freedom through passive income from multifamily real estate. She also brings over 17 years of corporate experience in business strategy, finance, and integration at the Walt Disney Company and holds an MBA from Stetson University. Kelly, thank you for being with me.
Thanks, David. I'm glad to be here.
So, how'd you get started in real estate? What made you get started? What set you on this pathway?
So about 6-7 years ago, my husband and I had this kind of epiphany moment that we needed to save more money. We were investing in our 401ks through our company, and we just didn't feel like we were saving enough money. So that's when I really started doing research. I found the FIRE movement, the Financial Independence Retire Early community, and really opened my eyes to the thought that if you save more aggressively, you could really bring up that timeline of early retirement. And then an additional way to amplify that was real estate. Real estate really provides outsized returns compared to what we see in the stock market. And additionally, instead of having the money locked up in your 401k, it provides passive income or income on an ongoing basis, which can then pay your living expenses and fund that early retirement. So that's how we initially found real estate.
And what's interesting about what you just said is about the feeling of not necessarily saving enough for retirement. And I feel like both anecdotally from my social and professional connections, as well as articles I read and videos out there on YouTube and podcasts, that a lot of and I don't know where you fall on this, but the younger Gen X and the older millennials, that seems to be a common thread. And I know that you've worked with a lot of people to get into this. Is that a common motivator that you hear of from people?
Of not being able to save enough? Yeah, I am right on the top of that millennial. I'm a proud millennial. I had to go through all those years of talking down about millennials, but I am a proud millennial. And yeah, I felt like I wasn't saving enough. And I was very fortunate that I grew up in a family that had a lot of financial literacy, and my parents invested in their 401ks. They worked at the same company for an extended period of time. They got pensions. They retired at 50. And to me, I thought that was normal. So when I then transitioned into the corporate world, I went into it thinking, well, I'm going to retire when I'm 50, and then realized the company I was working for, their stated retirement age was 55 in order to qualify for the pension or get the pension. And then as I continued to learn that the standard retirement age from like the Social Security Administration is 65 plus, and that so many people don't save enough in order to be able to retire at even 65. I mean, there's some people that just have to work really until they can't work any longer because, there's obviously systemic issues as well, but the financial literacy and the lack of financial literacy our country, I think, shares is a real problem. And so part of what I'm doing now is not only in just real estate syndications, but helping share in that knowledge and education that I've learned along the road, as well as providing opportunities for individuals to be able to share in that outsized return from real estate.
And I think that's great. And I appreciate the education component of what you're doing. And that was one of the biggest reasons why I was excited that you were willing to come on here. And so let's educate me, certainly, and probably others. When in your bio, and then you just mentioned it again, real estate syndications. What does that terminology mean? Because it's not one I'm familiar with.
So we hear about syndicates or syndications in all different forms in media and real estate, and other forms as well. Really, what a syndication is syndication is pooling of investor capital in order to acquire an asset larger than someone might individually be able to acquire on their own. So it's the pooling of individuals' money in order to acquire a larger asset. And syndications have been around for well over 100 years. But up until recently, it was only available to really the wealthy, those individuals with net worths of well over $1 million. And now there's provisions through the Security and Exchange Commissions that individuals with a net worth below $1 million can also invest in syndications, provided they meet specific parameters. So it's really now what used to be a gentleman's club or a golf course conversation is really coming to Main Street and is available to so many more individuals.
Interesting. Okay.
Yeah.
I don't know if I gave you enough technical prep before we got started to deep dive on some of these things, but when did that change occur? Is that a pretty recent change?
I believe it was in the late 2000s.
Okay.
I believe I would have to do some research. Yeah. And maybe we can put it in the description for the video or something like that. But, and these are different than something like an REIT, right? They're different. Absolutely. Or they're the same? They're very different. So REIT, which is a real estate investment trust, is a typically publicly traded on the stock market. And they're simply trusts that are backed by the real estate that is being acquired. The big difference is that whereas a REIT is largely publicly traded and it's traded on the stock market, a real estate syndication is typically a privately traded asset. So we have private placement memorandums. People are investing individually. They can invest through their LLCs and trusts and stuff, but they're investing in more individually one-on-one with an operator on a specific asset or into a fund. And it's totally disconnected from the stock market. So when we think about diversification, a lot of people, and I used to think this as well, that my stock portfolio or my 401k portfolio was diversified because I was invested in, say, the total stock market, or I was invested in a certain share of international, certain share of domestic, certain share of bonds. What I've realized through my own education is that that's not really a diversified portfolio because it's still tied to the stock markets. They're all paper assets. So when there's big news, March earlier this year, there was a huge stock market drop. Even the REITs that were backed by real estate, we saw the big drops there as well. In the private arena, we did not see that same drops. Real estate is largely recession resistant because there's so many benefits of it, both tangible and non-tangible. But it's a great opportunity for people to then diversify their portfolios outside of the stock market. So REITs, and then what I'm doing in syndications, which are really driven by private placements, are different from each other.
Okay. All right.
Pros and cons to both, which we can go over high level.
Pros and cons to both.
Yeah. Okay.
And the picture that you're painting is great. And I think it actually leads into one of the questions that we did talk about in advance, which is I've often read that really in any business, but particularly in real estate, where if you can, you want to get started with, quote, other people's money, right? Rather than your own. And so I think that's some of what you're talking about here is, right, these private opportunities to invest, to find investors. So in your world, what does that mean, using other people's money to invest?
So in my world, we use other people's money to invest all the time. Just like you might individually, when you go purchase your primary residence, you go to the bank to get a loan for, say, 75 to 95% of the cost of that house. That is using other people's money. We do the exact same thing in these larger syndications. We use the bank's money. We typically have what we call a capital stack. And just like when you buy a primary residence, a certain percentage of that is going to be covered by the bank via a bank loan. And that's, let's just call it 75% for easy math. We will then raise capital, raise investments from for the other 15% per se, from what we call passive investors. So people who can invest passively in the deal, share in the returns, but not in the day-to-day operations or work of the deals. And then the remaining 10% is typically brought by myself and my fellow general partners. We are the active investors in the deal. So we're the ones finding the deal, underwriting the deal, and really operating the deal from that point forward. And so we are investing our own capital in the deal as well. So when we think about using other people's money, there's really a few different ways to do it. We are inherently doing it consistently, again, even as you buy a primary residence. But I think where people take it to the extreme, and where I always like to kind of challenge people's thoughts, is that they can invest in real estate with no money. Can you? Yes. Is it the smartest, most advantageous thing to do? Maybe not. I would challenge, well, if you can find a deal and you don't need to put any money into the deal, that's fantastic, but you still need to have money so that if something goes wrong, you have a pool of capital that you can pull from to solve whatever problems there might be. And I think that's important with so many things in life. Like, money solves the problems. So even if you invest with no money or other people's money, you have to have a pot of capital so that you can solve if there's an issue that comes up in regards to potentially a resident that's moved out and you have a longer vacancy than you would expect. Maybe you have a tenant who isn't able to pay and you're going through an eviction process, or you have a roof replacement that needs to be done and you've got to foot that bill. Having that money of access to capital and money available is extremely important. So I always like to argue with individuals when they talk about investing with low or no money down. Yes, you can do it. Make sure you have a pile of money so that if something comes up or there's an issue, you can resolve it.
That certainly resounds with me. So my exclusive experience with rentals was had a house, moved for a job, kept my old house because I'm like, oh, okay, this is something maybe I'll get started on rentals, add some extra income, single family, not multifamily, and had my first and only tenant. Between the damage when they moved out, the eviction process, and the lost rent of going through all of that process and the repairs and whatever, it was about $10,000 in combined damages and lost income. So for me, that hits home. And honestly, it makes me tentative or hesitant, I should say, to get back into the real estate world. And so you mentioned that some of your portfolio or some of your investments have more passive investors where they're not in that day to day. So can you talk a little bit, because maybe that's where somebody like me would want to get involved. And so can you talk a little bit about that role in these investments and how much of the risk do they undertake the risk as well, I assume, or is it just they put their capital at risk by giving it to you? Are they truly out of the day to day? What does that role look like?
Great question. So as a passive investor, you are totally out of the day-to-day operations. So one of the questions I get a lot of is, as a passive investor, are you really passive? And I always like to say yes, but as a passive investor, your work is really on the front end. It's initially vetting the operator, so somebody like myself and my team, as well as vetting the specific deal to the extent that you want to vet the specific deal. That is the work that a passive investor is really, I shouldn't say required, you're not required to do it, but should do in order to vet the deal and the operators. At that point in time, once the decision's made to invest in a particular deal and you sign all the legal documents and the subscription documents, once you wire your funds, at that point, you can kind of sit back, go on vacation. You're not going to get any calls for day-to-day issues. What you would expect moving forward then is you will get monthly communications from myself and the other operators on a monthly update on what the operation's going through, what rehabs are taking place in the progress, as well as financial updates. And then once distribution starts, which is usually 6 months to a year after we acquire the property, once we've had an opportunity to stabilize it, then distributions will start and you'll receive quarterly distributions into your bank account. And that is your passive income. You are not engaged day to day. One of the other things you asked was about liability. We call you passive investors. The technical term is a limited partner. So you have a general partner, which would be like myself, the active investor. And then you have the limited partner, which is the passive investor. As a limited partner, your risk, both liability and financial risk, is limited to the amount of capital you put into the deal. So if you put $50,000 into a particular deal, your risk is that $50,000. Worst case scenario is you lose that $50,000.
Right.
As a general partner, we carry the liability risk. Well, let me asterisk that. We have insurance for everything, just like you would as an individual house. We buy everything within LLCs. If there is negligence, that's always the big carve out, right? If there is negligence and we act in bad faith or we do something illegal, where that liability falls is with the general partnership team, not the limited partnership team. So as a passive investor or a limited partner, your risk is limited to the capital you put in, which is secured and backed by real estate. And then there is really no liability risk that falls to the general partnership team.
Okay. And then, of course, I assume the lion's share of the reward falls to the general partnership team because you're putting in all the work, you're footing the liability, things like that. I would imagine that's where the lion's share of the reward is going to be, reaped, which makes sense. Is that am I correct in that understanding?
Yes and no. So the way that deals are typically set up, like a very standard deal, is that 70% of the deal goes to the limited partners and 30% goes to the general partnership team. And keep in mind that 30% that goes to the general partnership team, you're usually talking about 6 different general partners who are actively working on the deal. It's a team sport. Where we see the outsized returns is relative to the amount of capital that we put into the particular deals. We see the outside returns there because we get additional equity because of the work that we're putting into the deal. We are, as general partners, we are largely, so there's 3 ways, I'm going to go into it real quick. There's 3 ways that I make money in a syndication. Through the acquisition fee when we acquire the particular deal, it's usually 1 to 3% of the purchase price. That goes to the general partnership team, the managers. I make money through asset management fees. These ones are really small. It's usually like 1% of gross rents through the hold period. Really just keeps the lights on. But the bulk of my returns as a general partner comes when we sell the asset and my share of the profits. So the way that we set them up is typically limited partners will get what's called a preferred return, and they will receive, let's say it's an 8% preferred return. They will receive all of the profits up to 8% before the general partnership team starts sharing in those returns. And then as the returns increase, the amount of returns that go to the general partnership team increases. So we are incentivized to perform and to drive the highest returns we can for our investors because that's what we are really rewarded as well.
Okay. And so if a lot of your return is coming on the sale of the asset, are these, maybe I didn't have the right picture in my head, are these investments typically things that you're, for lack of a better word, or maybe it's a bad word, but flipping, or is it something you're holding and renting out over time, or is it just a mix of all of the above?
I think a great way to think about it is flipping a house, except for this is much more long-term flip. So everybody has different strategies. My strategy is what we call value add multifamily. So think of apartment complexes, But we are looking for an apartment complex that hasn't been renovated in a number of years, maybe has what we call mom and pop owner. So maybe they're heavy on labor for as far as maintenance goes, but they don't have the efficiencies. Maybe they're not keeping up with rents, like rent increases year after year. So there's opportunities from there. So when we acquire these properties, we will go in and reposition them. And then we'll typically hold 3 to 5 years. Because when we're buying a 100+ unit apartment complex, unlike a house that you might be able to get in and out of in 3 months, it will take us a solid 24 months in order to renovate every single unit. We're typically renovating 4 to 5 units a month, but we're going to time it with when we have turnover of residents. So it's going to take 24 months or so just to reposition the property. And then we need to season the financials of property. And by seasoning, I mean, we just need some time to go by when we have the profit and loss statements, the net operating income to show the stabilized asset before we would then take it to market to sell and really get the bulk of the returns for the investors and the partners. So thinking of it as a flip, but a very long-term flip and on a much larger scale is an accurate way to think about it.
No, I love that. That makes tons of sense and paints a really good picture. And so thank you for that. So we've used the word passive a couple times here. So I'm going to go to my Dave Ramsey quote, right? Which is there's no such thing as passive income and certainly not in real estate. But you've laid out a picture where I think at least for the limited partners, maybe Mr. Ramsey's wrong. What would you, if he was here on the call, what would you say to him about there's no such thing as passive income?
I would say yes, but, and kind of going to what we talked about earlier is that the passive investors or the limited partners, their work is really front loaded. Once they've done that work, then it's passive because they're not involved in the day to day, but their work is front loaded. I would also argue, because a lot of people are put off by the perception of the amount of work that might go into acquiring real estate, either as a single family directly or through a syndication, and think it's easier to just invest, again, through their 401k or through a brokerage account. One of my challenges is that everybody should do the same due diligence, whether they're investing in real estate or stocks and bonds. The reality is that when we invest in a company, we don't have access to financial data or what's really going on inside those companies. What we are receiving is a very through their quarterly updates or annual earnings updates. What we are receiving is a very curated look at the business of what's required by law and accounting and what the company is ready and willing to put out at that point in time, knowing potential impacts from a stock perspective. When we're talking about real estate syndications, or even if you're buying an individual property on your own, we have access to all the information. As operating partners or as the general partners, we have extensive underwriting documents and research that we're getting from both research firms and then just our own organic research that we're doing to validate the data we're getting. I am always available and open to my investors if they want to jump on a call and we open that underwriting document in Excel and flip through it to their comfort level. That is something that they have access to. They can ask questions. They can poke holes. They can ask. One of the big things is rents have really been increased. I mean, we've had historic rent increases the last couple of years. So a very good question from a passive investor is, what are you projecting rents to increase in the next couple of years? Because it shouldn't be 10 or 15%. It should be that normal 2-3%, maybe. Right. Maybe it's flat in the next year or two, given where we're at in this where we're at in the economic cycle. But also it's good to have the perspective of the type of deals that we're doing where we're value add is we're not betting on market appreciation. We're forcing appreciation through the renovations and the operational efficiencies for these particular properties. So from a passive perspective, I think that is key to know that it is passive after you've done the front end work and what you should be doing in any investment you do, whether it's a stock or real estate.
That's so true. That's also why I don't generally do individual stocks unless it's some company that I really believe in or something like that. I go with sort of the the Warren Buffett, like, look, just put it in a fund, in an index, and unless you're going to do the diligence. So I think that's very good advice to anybody thinking about investing in anything, is you can't just blindly throw your money at investments and hope for the best.
Mm-hmm. Absolutely agree. One thing I'll add in there, I'm totally with you. I'm Vanguard low fee index fund all the way for what I do have in the market. But I also have I have a Sting Movie Pass. If anybody remembers Helos and Matheson and Movie Pass, it was, I don't know if it was before COVID or early COVID, but it was this basically contending against AMC's subscription where you could go to all these movie theaters. I thought it was a great idea because people don't want to be nickel and dimed. People want to just pay a flat fee and then go and do it whenever they want. I didn't do my due diligence to look at the fundamentals of the business and the contract negotiations with the different theaters. And if they were, they were losing money left and right. I lost $1,000 on it because I kept trying to catch a falling knife. Every time the share price went down, I just kept putting money in. And I couldn't stop. And so it was that was my last straw when I went, I'm not doing individual stocks. It is low fee index fund. My time and energy is better spent focused on real estate, where I really I'm in deep and I'm ingrained in the business, and that's where my knowledge is. So otherwise it's low fee index funds. I agree with you there.
Yeah. So that anecdote kind of speaks to, I had mine earlier about my bad experience. You had that one there on individual stocks, but what are pitfalls, landmines, things to avoid bad experiences in your world? We'll get out of stocks and back to your world. If somebody's listening to this is like, that sounds really interesting, I want to do that, what are some pitfalls, landmines that they want to avoid?
It kind of echoes the whole Movie Pass situation there. People get really excited sometimes. You've got two spectrums. People have a lot of fear when it comes to real estate. And once people get it, they get really excited to get involved. And that excitement drives people to get into deals without doing proper due diligence, both on the active side, but also on the passive side, both, buying individual houses or in these large syndications. So one of the big pitfalls is really keeping in check your excitement and the reality of that this is a numbers game. And this is what I love so much about real estate at this scale it's a numbers game. It's not about what the property looks like. I mean, we look at the properties, obviously, we look at the neighborhoods that they're in, but our first check is, does it make sense from a financials perspective? And does it check out when we look at what are comparable properties? It's better to do no deal than to do a bad deal. So that is really important for investors to know, both on the active side and on the passive side. I have investors who have invested who I've never spoken to before, and they just went and invested, and they show up in my investor portal. I'm like, hey, who are you? Hey, you want to jump on a call and talk? And I'm like, okay. And it was like, I was putting them out just trying to have a conversation because I want to, one of the things for me is I want to make sure that my investors and I were on the same page, that we have the same philosophies, that what their goals are can be met with what I'm providing, and that there's, that we're on the same page there. And then I have investors who I've spoken to for months who finally invest. It scares bejeebus out of me when somebody just invests without having a conversation or without, engaging in a few different ways, because while I know that I am a good guy, good girl, and I am doing my due diligence and I am confident in what I'm offering, I am sure that there are operators out there that are not. And that scares me because I genuinely care about people, and I genuinely believe that this is a fantastic path to financial freedom. And I want people to have a good experience with it, just as I have, and learn from, my learnings and my knowledge through that process. So that's one of the biggest pitfalls, is that people get too excited to get going and jump into a bad deal. And it's better to do no deal than to do a bad deal.
And that makes sense. And the other thing, I think the subtext of what you said is the obviously the emotion and the don't jump into a bad deal out of excitement, but also the subtext there to me is a bad relationship, if you will, with the general partners, right? Because even as a limited partner, you are putting your capital at risk. And I think what you mentioned there about you feel that you're a protagonist in this industry. You're a good actor in any given population of human beings. We look at doctors, we look at nurses, we look at lawyers, we look at whatever. There's going to be an array of people who are great, people who are average, but mean well. But there's going to be some people in that group who are maybe not good at it, or good at it, but not as moral as you want them to be. So I think the subtext there about the relationship seems important as well. I mean, do you feel like I'm accurately picking up on the importance of that?
I think you absolutely are picking up on the importance of it. And that was even, I've mentioned I work on a team. I've got business partners, and that was very much part of my conversations with my business partners, understanding, are we all looking for the same thing? We don't want to be in deals we're not proud of. We want to make sure that our residents have safe, clean, attainable housing. We care about providing a good service for our residents and serving them, but then also obviously serving our investors, because without our investors, we don't have a business. But
right.
It is a balance of making sure that we are attaining all that. One of the things that I did to help combat, or one of the things I put out there to help illustrate my morals, my values, my vision, if you will, is that I'm pretty open about my husband and I's journey of kind of going through this path of financial freedom. And that when we went through this, we decided we wanted to live on one income. So we made, while we both had W-2s, how do we figure out how to live on one income? Because that was important to us in order to build this strong financial foothold, which I believe puts me in a position of strength when I'm looking at deals, because each deal I'm not reliant on each deal. It needs to be a good deal as opposed to just getting in any deal. Because again, we do get paid through an asset management fee when we close. So there's some operators that just want to close as many deals as you can because that's how they're getting paid. Short-term thinking. I am very much a long-term thinker. This is basically a long, if you've got corporate, I don't know who your viewer base is, but if you have a corporate employees, potentially executives, this is the long-term incentive plan. You're doing something now for the long-term incentive, and long-term is 3 to 5 years. So that's the vision that myself and my business partners have when we go into these deals, is that, yes, we'll get a little bit on the front end, but it's the long-term vision, and it's performing for the residents, the community, and our investors.
That's great. And particularly the point of making sure that with your partners and with your marital partner, you have shared philosophy, I think is really key. And actually, I want to take a left turn over into that topic. I think that if I may, I think a lot of folks are hesitant, perhaps rightly so, to do business with their spouse, and what's that experience been like, and how do you, kind of keep work over here and marriage over here? Like, how do you balance that? Because that brings a new meaning to work-life balance, right? When they're very heavily overlapping Venn diagrams. Yes.
And in many different ways, because my husband and I both also have worked at the same company. So, not only not in the same teams and stuff, but like we've both worked at the Walt Disney Company for almost nearly 18 years. So we've always had that where we speak the same language from that perspective. And then really growing this real estate business, we have our roles in the business and we have our swim lanes, if you will. I am, in knowing what those are, as well as balancing the family, we also have kids. So it's really having the conversations, communication's key. And we've always been great at just being open communications. Even if we get in an argument or a fight, we communicate in order to get through it, because, that's what happens in life, and communication's key. But we have our swim lanes. We know what each of us are stronger at and what brings us joy and what is easy work versus heavy work. I am very much the type A personality. I'm the driver. Like, I'm going to do this. I'm going to go do it. I don't know what's going on over here, but I'm going to focus on this. Mm-hmm. He is very details oriented and very much what's the worst case scenario and how do we solve for it? Mm-hmm. And so we bring a really good balance of, here's the goal, here's a path to attain it. How do we mitigate risk in order to do that? And, oh, by the way, our children need taken care of too. So really balancing that, but communication is key. But there are, again, because I'm the type A driver that has a hard time turning off. There are times where he's like, you have to just stop. Like, we need to put a pin in it. I don't want to talk about this till tomorrow. You need to focus on the kids or whatever. It happens. And so it's just a matter of then recognizing, being like, yep, you're right. Let's proceed. But communication is key in marital relationship, business relationships, with investors. Even with that point from investors, we send out the monthly updates, and I've got one particular investor who will not hesitate to pick up the phone and call me and ask additional questions about the updates. And that's totally fine, because you know what? She is investing her hard-earned money into these deals. And I respect that, and I value it. And that's what I owe her, is answers if she has questions.
I think the focus on communication is great. Understanding roles is really good. Being able and willing to set a barrier, set a stop time, or just say, hey, look, it's dinner time. Let's put the laptop down or whatever and step away. I think those are all good tips for people considering going into business, both with their spouse and probably with friends, right? As well as you don't necessarily want to lose a friendship over a bad deal. And so that was actually one other thing I was going to ask. Did you know, or were you friendly and social with your general partners before you got into business with them as well? And if so, do you have any tips on working with friends?
No, I was not. So okay. When my husband and I, we had a 6-unit apartment building. And as we started to really shift to think about how do we scale and how do we make a bigger impact, I started really networking and getting to know other people in the syndication world and who were actively doing syndications, some of who live locally. I'm here in Central Florida, and then some who live in a couple of our other locations. We do business in Florida, Georgia, and Texas. We have a partner in Dallas and a partner in Atlanta area. But it started off as a business relationship, but it started off as, let's date a little bit. Let's have some conversations. We met up at a conference that we were all attending. We went out to dinner, me and my husband, him and his wife's sister attended. And we just kind of had dinner. You talk personal stuff. You talk about what the business vision is, talk about what we've done in real estate, what he's done in real estate. And then, set up time to introduce me to the rest of the team that he's been building. And it's really kind of like that kind of dating, understanding, asking a lot of questions. And then, okay, here's an opportunity. Let's do business together. And from that first deal, we just closed on our 4th one yesterday. And I'm continually, what's the word? Reassured that our values are aligned. When we talk about, it's very common that our team will JV with other teams on deals. It's very much a team sport. You see this a lot in the space. And we're continually having conversations of how things are handled, how we would handle them if we would handle them differently. How do we do it differently on a different deal? What can we do better? What went really well? And we're continually having those conversations. And at the forefront is our investors and the residents, and making sure that we are meeting the standards that we all set ourselves to.
So through all these conversations that you're having, these deals over the last several years, you're up to, I think it was 409 units that you've either have now or
579 as of yesterday.
579 as of yesterday. Congratulations. Breaking news as of when we're recording this in mid-November. So congrats on that. So 579 units. You probably have been able to see through or dispel some myths in real estate. What are some real estate myths that you want to break down?
Yeah, so I think there's three big myths that a lot of people are that puts fear in individuals. One is the personal liability, and that the personal liability risk is outsized comparative to the returns in particular properties. There are a lot of ways we mitigate that, and we talked about that earlier as far as deal structure, and then obviously from a limited partner, it's very limited to the actual capital you put in. And on the general partnership side, we carry insurance and everything. So unless we are negligent or intentionally doing something unethical, illegal, that's where the liability risk comes in. The second one I would say is that the perception that all landlords are slumlords. I have never had that intention. I will err on the side of slightly over rehabbing a property in order to take care of a resident or make sure that they are set up, because I truly believe that individuals deserve to have a good, safe, comfortable place to live. And one of the big things I really feel strongly about is people should have access to washer and dryers within their unit. So that's something that, as we've done our individual projects, spending the extra money to add in the electrical and the plumbing fixtures that are needed in order to try to put them in, even if they're, our 6-unit, it didn't really have space, but we put in the European style where it's washer dryer combo, just so the residents had access to it within their unit and they didn't have to go to a laundromat. And then the third myth that we hear all the time is that residents, the resident's just going to destroy my unit. And I know you shared your experience of when the individual moved out. I have found that by and large, that's not true. I haven't had an experience like that to date. I'm sure at some point I will. But it's a business. And this is the benefit of going larger and doing these much larger deals. My single family, or like your single family, was almost $10,000 expense. And when you're talking a single family home, I would imagine after you paid mortgage and all the expenses, you were probably only making $200 a month. So that wipes out years of profitability on a single family house. But when you're talking 100+ unit and you have a resident who does that and it's a $10,000 hit, you're talking so many more units that absorb that expense, and you're buffering it by your reserves and maintenance cost, that it is not as big of an impact because of the economies of scale that we see in the much larger multifamily units. The other big thing is that, people talk about all the bad stuff that happens or all the newsworthy things. Screening residents is super important to help prevent that as much as we possibly can on the front end. So we have pretty stringent screening criteria, not only for ourselves, but also for the other residents that live in the particular locations. We're doing background checks, credit checks. We're verifying that their income is 3 times the rental amount so that we know that they can safely afford the property that they're moving into. And these are all ways that we try to mitigate those risks.
No, that all makes sense, and I appreciate you breaking down some of those myths. The first of which we obviously talked about in a little bit more depth earlier. Let me go back to the upcoming millennial question, and what I mean by that is, I think to date, you and I sound like close in the same age bracket. Then that. All these articles have been written about how millennials want to live in cities and millennials want to rent. And I'm like, do they though? Or is it just the fact of, burdened with student loans and the rising cost of housing and came of age around the Great Recession and then now COVID and so forth and so on? Are those barriers to home ownership significant enough that it looks like millennials want to rent, but really they want the same thing everybody else wants, which is, independent, freestanding homes or something like that? And I say all that to ask, do you think that the successes, and I'm asking you to get your crystal ball out here, do you think that the successes you've seen in multifamily are long term? You said long term, 3 to 5 years. I'm talking 10 years, 15 years, are sustainable as our generation comes of age, maybe overcomes some of these barriers that I mentioned, and starts to look around and go, do I still want to rent? Because I know the generation coming up behind is a little bit smaller, and then the boomers are retiring and so forth. And so when I look at the demographics, that's just something that makes me wonder on a 10, 15, 20-year time horizon, what's going to happen with multifamily rentals? Have you ever given much thought to that? And if so, what do you think on that type of time horizon?
Great question. Great question. So there's a lot of pieces in there. I think it's a lot bigger than just millennials, because you're right. Millennials is currently, I believe, the largest living generation. And you're right. The generation behind Gen Z is slightly smaller. Then we have baby boomers who are obviously aging, and we're seeing some buy down from that, that generation that want to live in smaller places. I think the big thing is supply and demand. So the United States is estimated to be short, I believe it's 4 million household units or housing units by 2035. We have a long-standing housing shortage dating back to the '08 financial crisis, when real estate was hit so hard because the fundamentals weren't stable at that point in time. Mind you, the fundamentals are very different right now, and they're very strong. But at that point in time, the housing industry was hit so badly that housing starts stopped. People that were going into the trades at that point in time stopped going into the trades and learning skills like electrical, plumbing, the construction skills. So we have those several years of housing starts being really slow, and that impacted the availability of housing that we see today, as well as, of course, COVID exacerbated that issue because of the restrictions that we had on movement and just COVID in general. So housing supply is a big issue. So we are expected again to be short 4 million housing units through 2035. Now, what we expect to see from a demand perspective, to your point, is millennials right now are at this peak household generating or formation period of time. We are, it sounds like, both on the older side. So we've kind of gone through that. Hopefully we skirted the student loan, the big student loan crisis. But millennials are currently at peak housing formation period of time. And then the Gen Zs are coming up behind it. But we're also seeing on the other end of the spectrum is baby boomers who are getting older and looking for more services in where they are choosing to live, as well as buying down from their family homes. So we see this demand continuing to be strong. The other thing that we look at is job growth and population growth. So I mentioned that we invest in Florida, Georgia, and Texas, which are all fantastic states when we think about the net population growth. People are coming to them year after year after year, and they're continuing to grow. And the job growth that we're seeing in these particular locations and the markets we're looking at are also key to deciding where we are going to look for projects and invest. I do expect that we will obviously monitor these dynamics as we get 5, 10, 15 years down the road. But at this point in time, we are still looking at multifamily having very strong fundamentals from a finance perspective, but also from a demand and supply perspective. So I do have a challenge. I'll just elaborate a little bit more here is, we have the rising interest rates to help inflation or help bring down inflation. We have a lot of discussion around affordable housing and the lack of affordable housing. My challenge is that it's not an affordable housing issue. It's a supply issue. We don't have the supply. And part of that is we generally don't want apartment complexes, 55 and older condominium buildings built in our backyard. I repeatedly hear about, and I live in a golf course community. Our golf course is not private, it's public. It's gone through some turmoil. And we recently, the HOA was able to work with the city and buy the golf course out of bankruptcy from the prior owner. And part of all these different scenarios that we looked at from an HOA perspective was, do we sell off parcels of the golf course? And we had developers come in who wanted to build luxury 55 and older condominium communities. And guess what? The community voted it down because the community doesn't want that in our backyard. And that, another quick example in a nearby community, maybe 10 minutes from where I live, right between the Turnpike and 50, which are both very busy roads. One of them's a big toll road in Florida. The other one's just, 6-8 lane main road, which is this parcel is across from where the city center area is for this town. They voted down putting an apartment complex there. What else are you going to put on a piece of land that basically is surrounded by super busy roads? But they didn't want it. And again, this is part of the issue, is that people in general, I'm going to say people in general, I'm using air quotes, don't want these big communities in our backyard. And that exacerbates the issue, but that's not what is being targeted to solve in a lot of cases.
Yeah, no, that's a great answer to the question. And it's something I've been puzzling about and pondering about for a long time, about the whole, what's going to happen as we get these demographic and generational shifts. And the one near the crossroads, for me, that's kind of a no-brainer. Sure, build an apartment building. If I'm in a neighborhood and I'm a member of an HOA and we're going to turn a golf course into apartments, I have to admit, I'd probably be on the fence. I don't know where I would vote on that. It'd probably really come into the plans and how dense are we talking? And I mean, there's probably a lot of details but you're right. I do think it's human nature to sort of either want to keep a status quo and say, no new development of really any kind, or B, only the kind that I find pleasing, right? I think those are both just human nature. And it's fascinating because as you say that, I'm starting to think about, is this part of why, in the States anyway, in the United States, we have so much suburban sprawl that, from my readings anyway, we don't see as much in European countries because we've got plenty of room and not in my backyard. So build it down the road, build the apartments down the road, build the housing development down the road, build the warehouse. The fact and the more we keep saying build it down the road, the more we get sprawl. So it's interesting to think about. One question then that as we start to get kind of wrapping up here, that I'm curious, you mentioned about your investments have been successful in the states you're in, and those states have good growth. Are these syndication opportunities, are those governed on a state-by-state basis, or can somebody in Seattle or California, which is struggling with outward migration, could they invest with you in Florida? You know what I mean? Because maybe they say, well, I don't want to invest here because we've got the population that's shrinking. I want to invest where it's growing. Can I reach out to a Kelly or a Kelly equivalent in Texas, Florida, Georgia? Ohio's got some growth, but not as much where I live. Or does it have to be a state by state kind of thing?
Nope. You can invest anywhere throughout the country. So you can, regardless of where you live, and quite frankly, a lot of my investors are based on the West Coast. I'm based here in Orlando, and our deals are, kind of on the southeast here. So that's the great thing, is that you don't have to invest in the state that you live in or in the area that you live in. So if you're in one of those really high cost of living, cost of purchase, where it doesn't make sense to buy real estate, or the governing dynamics are not as favorable to landlords, then yes, absolutely, you can invest in a syndication in a different area. We adhere to federal guidelines for the Security and Exchange Commissions, but the deals, you can invest in any of the deals around the country.
Okay. That's just good for awareness. And then the last thing is, we've focused almost exclusively on the real estate, how you got into real estate, investment opportunities, risk, myths, etc. We didn't really dive into, and you probably do a whole separate conversation on your involvement with the fire the early retirement and what that looks like. Because I know there's so many different opinions of how to do that, and the best ways to do that. But if somebody is out there, kind of like you and where your husband and where you were saying to yourselves, I don't know if we're putting enough away. What's one thing you would say to somebody who's thinking about trying to pursue or investigate the FIRE universe? What's one tip you would leave them with as we sort of round out our hour?
It's hard to pick one.
Hard to pick one. That's fair enough.
One. Okay. I think I would say the first thing to do is, God, it's hard to pick one. I'm going to give you two. The first thing
that's fine.
Is lay out all your assets and liabilities and get a pulse on what your current net worth is. It may be negative, and that's okay. You just need a starting point. And then two, I would seek out podcasts, if that's your forum, YouTube channels, if that's your forum, that really talk about the FIRE movement and different strategies and ways to think about it. A great starting place is both for real estate and for the FIRE movement, I would say, is Bigger Pockets. They have a Bigger Pockets Money podcast. And I think that's a good place to start. There's also the Choose FI community, and they've got a podcast. So those are kind of a couple good places to go to start getting educated and thinking about the FIRE movement and how to think about your mindset as it comes to your finances and getting financial literacy, to start to put yourself in a position to think about how do you align your spending with your values and carve out space to be able to invest more in order to achieve those goals.
Wonderful. Thank you for those two tips for people interested in learning more about or pursuing the FIRE movement. And Kelly, where can people find you?
So I'm most active from a social platform perspective on LinkedIn. So feel free to reach out to me, connect with me on LinkedIn. And then my website, you can visit my website to learn more about me and my business, or set up a call if you want to jump on a call. My website is www.waypointcip.com. And that's waypointcip.com. The CIP stands for Commercial Investment Partners. Like I mentioned, there is a place on there to either sign up if you want to see future offerings, or if you want to set up a call with me and kind of talk about where you're at in your journey, or just have general questions. Happy to jump on a call.
All right. Well, thank you for being with me. I think it was really fascinating for me, again, to go beyond what I talked about in episode, I think it was 8, about doing this as a side or income, some extra income versus a pursuit of the financial independence and different ways to structure it rather than just fully owning rental units. So I really appreciate your time and your education for me and for anybody who might listen. Kelly Iannone, thank you for being with me here on No Bad Questions.
Thanks, David. It was great to be here.